Welcome to today's Explainer. We're taking on a topic today that honestly might seem incredibly dense at first glance. We're talking about the rules surrounding Irish Investment Limited Partnerships, or ILPs. But as we unpack this together, the logic really starts to emerge. If you're an investor, a fund manager, or really any financial professional, understanding the nuts and bolts of this vehicle is absolutely crucial, especially with the recent legislative tweaks. So let's get right to it. Right, so everything we're looking at today comes straight from the source, the official Irish Revenue Tax and Duty Manual, Part 27-01A-04. Specifically, we're looking at the updates geared for April 2026. Now, I know official tax manuals can be a total snooze fest, just wall-to-wall statutory cross-references and legal jargon, but don't worry. We're going to extract exactly what you need to know to navigate these rules with total confidence. Okay, let's dive into this. Here is our roadmap for today. We'll cover what an ILP actually is, the big tax transparency shift, dividend withholding tax exemptions, the interest and hybrid rules, and finally, filing your Form ILP1. Section 1. What is an ILP? The structural foundation. Let's start right at square one. Grounding ourselves in the basics, an ILP is a regulated investment fund vehicle. It's authorized by the Central Bank of Ireland under the 1994 Act. Look at the dynamic right at the heart of this partnership. On one side, you have the general partner. Think of them as the ones steering the ship. They conduct the business, and crucially, they are personally liable for the debts of the ILP. On the other side, we have the limited partners. Their liability is strictly capped at whatever capital they've contributed. But here's the catch. A limited partner can actually lose that protective shield if they step out of bounds and start conducting business with third parties. Thankfully, the 1994 Act provides a really broad, safe harbor of activities a limited partner can do without crossing that line, which is a massive advantage over the older 1907 partnership structures. All right, Section 2. The tax transparency shift, the paradigm pivot. Now that we know who's who, let's get into the real core of the tax mechanics. And this brilliantly illustrates the big shift. For the longest time, the tax treatment of these funds was totally different. ILPs authorized before February 13, 2013, were treated under what's called the gross roll-up regime. Notice the timeline, though. The Finance Act 2013 drew a hard line in the sand. Any ILP authorized on or after that February 13th date pivoted completely away from that old regime and became a tax-transparent entity. So, what does tax transparency actually mean in the real world? Well, under Section 739J, it basically means the ILP itself isn't the primary taxpayer for these gains. Instead, think of the ILP as a perfectly clear window. The income and gains pass straight through that window and accrue directly to the partners exactly in proportion to their partnership agreement. So, the Irish tax burden doesn't sit heavily on the fund itself. It depends entirely on the limited partner's own specific tax profile. It's a highly, highly individualized approach. Now, what's super interesting is how the manual handles losses. Because transparency works great for profits, right? But it absolutely has to work for losses too. Section 739J says losses must be allocated to the partners. But what if the math doesn't perfectly align? What if the total losses allocated to the partners is somehow less than the actual total losses of the partnership? Well, Revenue outlines a crucial failsafe. Any leftover balance lands squarely on the lap of the general partner. This guarantees that absolutely 100% of all profits, gains, or losses are accounted for. Moving right along to Section 3, Dividend Withholding Tax Exemption, clearing the tax hurdles. Let's see how this transparency interacts with dividends. So, the crucial point here is that the Finance Act 2025 brought some really excellent news. It amended the rules to include ILPs as excluded persons for dividend withholding tax. Getting that exemption basically comes down to a strict three-step checklist. Step 1, the partners must be beneficially entitled to at least 51% of the ordinary share capital making the distribution. Step 2, that share capital must physically be an asset of the ILP. And Step 3, the ILP has to provide the necessary Schedule 2A declaration. Check those 3 boxes, and boom, you clear the withholding tax hurdle. But, and this is a massive but that everyone really needs to internalize, exemption from withholding tax absolutely does not mean you're suddenly tax-free. The partners are still fully within the charge to tax under Section 20 for their share of the distribution. Unless a partner has their own separate, specific exemption, they are legally obliged to report the income and pay the tax via self-assessment. If you misunderstand this and drop the ball, you are looking straight at interest, late filing surcharges, and some pretty hefty penalties. Also, the manual explicitly points out that this dividend withholding tax exemption is still subject to the Outbound Payments Defensive Measures, or OPDM. I'm not going to drag you into the weeds of the OPDM today, but the big takeaway here is vigilance. The exemption is powerful for sure, but it is heavily conditional. Okay, Section 4, Interest and Hybrid Rules, Exceptions to the Rule. We've established that post-2013 ILPs are incredibly tax transparent, but it's tax law, so pure logic always bumps into statutory exceptions. Now, here's a rather fascinating regulatory quirk. Even though we literally just spent several minutes talking about how the ILP is a clear pass-through window, when it comes to interest withholding tax, revenue suddenly treats the ILP as a distinct person. It's a subtle but really vital distinction that impacts how interest payments made to the partnership are handled. It just proves you can't blindly slap the transparency label onto every single tax scenario. And speaking of complex scenarios, let's quickly touch on the reverse hybrid rules. There is an exclusion available, but your ILP has to qualify as a collective investment scheme under Section 835 AVB. How do you do that? Well, the key, which was heavily emphasized by the 2025 updates, is that the ILP must hold a diversified portfolio of assets. If your fund is too concentrated, you risk losing that definition and falling right into anti-hybrid restrictions. Let's move to Section 5, filing your Form ILP1, the compliance finish line. Let's see how this all builds into practical annual compliance. Mark your calendars, folks, because revenue definitely has. Under Section 739J, an ILP is legally required to hand over an annual statement to revenue detailing its investments and its partners. That magical date? It has to be filed on or before February 28th, following the year of assessment. Miss this deadline, and you are definitely starting the year off on the wrong foot. But hey, I want to deliver some genuinely good news as we wrap up our technical dive here. Before 2026, compliance was kind of a headache. An ILP had to file a Form 1 for firms and a Form ILP1. It was annoying, duplicate administrative work. But thanks to the Finance Act 2025, from the 2026 year of assessment onwards, the process has been beautifully streamlined. Filing just the Form ILP1 solely satisfies your requirements. The duplicate paperwork? Gone. It makes crossing that annual compliance finish line so much cleaner and faster. And that brings us to the end of our journey through this manual. We've seen the structural differences between partners, that absolute pivot to tax transparency, the strict hurdles for dividend exemptions, and the brand new streamlined filing rules. So here's the big question. With these incredibly streamlined filing processes and profound transparency rules locked in for 2026, is your ILP actually structured to maximize these advantages? Or are you leaving efficiency on the table? I highly encourage you to review your own fund structures with these updates in mind. Thank you so much for joining me on this explainer, for staying focused, and for exploring this with me today. Keep optimizing, and I'll catch you next time.